Hello, my fellow investors. Welcome back to the channel. This is your host, a strategic investor Alf, and I hope that you all having a fantastic, productive week while prioritizing your well-being and your loved ones. All right, so as usual, I have to do my quick disclaimer. I am not a financial advisor. This content is purely for entertainment and educational purposes. Please do your due diligence before investing in any kind of investment. Make sure that you familiarize yourself with the risk associated with them and be smart with your money. All right, moving on. All right, so let's get started. Before the end of the year wraps up, if you have been trading in and out of stocks or selling positions at either at a profit or at a loss, we need to crunch numbers on those gains. Okay. Why is that? Well, because like it or not, Uncle Sam wants his share. And this is what your taxes will be based on. Okay. Unfortunately, for my dividend investors and my distributor investors, this is not going to be really applying to you because dividends and distributions cannot be included in capital gains, and they are basically taxed differently. Okay. More on that down the line, but I think I'm just gonna maybe I'll dedicate a video on that. But what we're going to be focusing on today is going to be basically my swing traders, market sell-off, especially those selling off at a profit, and my day traders, okay? And another thing that we have to consider in this for capital gains is if you flip homes and you realize gains, this will be included as well if you do a little side hustle or you resell collectibles or you're doing cryptocurrency. This is all going to be part of capital gains, okay, or capital gain tax. Okay. All right, so first thing we're going to do, we're going to have to tally everything up. We're going to have to add everything, and what I'm talking about is basically your market sell-offs, whatever shares you sold at a profit. You're gonna add that along with whatever other income that you had, whether it's W-2 or your side hustle. You're gonna add all of them up. Okay. Once you have tallied up all of your profits, it's time to look at the flip side, which is basically our losses. Okay. And believe it or not, losses aren't all bad. In fact, they are the secret sauce that helps shrink those taxable profits from your income. Okay. So here's the good news. Once you calculate your capital losses, you can use them to offset your capital gains. Okay. And if your losses actually outweighs your gains, well, congratulations. Because for once, losing money might feel like winning because you could end up paying little to nothing in capital gains taxes. Okay, notice how I said capital gains taxes. I didn't say anything about dividends or distributions. Okay, now on the flip side, if after tallying up all of your gains and losses, you still end up with a profit, then we have got to talk about the big two things that terminologies that are going to be taking place here. And those are long-term capital gains and short-term capital gains tax. Okay. Now, I have touched on this in my previous video about tax lots. If you have not seen that video, I would strongly recommend for you to watch it because it's a tool that we can utilize to help us calculate and keep better track of our accounting, right? Anyways, now I'm going to sound like a broken record here, okay? But please do your due diligence and consult a professional CPA when it comes to the tax treatment of your gains, okay? That being said, here is my understanding. Short-term capital gains are taxed anywhere between 10% all the way to 37%, progressively, depending on your tax bracket, okay? Now, so what does progressively mean? I'm glad you asked. Let's break it down. Because this part is kind of especially useful for my swing traders and my day traders. Let's say you have got $50,000 in short-term capital gains. Okay, notice how I said short-term. We're talking about short-term here. The first $11,925 is going to be taxed at just 10%. Okay, now we subtract 48,475, which is the cap of the next bracket level, minus the $11,925. Okay, this is going to give us a total of $36,550. Now, this portion right here is going to be taxed at 12%. Okay, I'm hoping that I didn't get you lost there. Now, the remaining portion of that, in this case, is going to be the $50,000 minus the $48,475. Okay, that's going to give us basically the result of $1,525. Okay, or $1,525. Okay, now that is going to be taxed at 22%, which is basically the next bracket level. All right. If you need to go through it again, hey, you're more than welcome to it, or you can actually take a look at Google, or even better, you can just contact your CPA so that they can explain it way better than I would. Okay, because once again, they're professionals and they actually they probably have a better explanation of how to break it down for us. Okay, all right. Hopefully that cleared things up in terms of short-term capital gains. I know the tax code can be a little complicated, which is the reason why so many of us just grab that 1099 from Robinhood and just handed it straight to our CPA. Okay, but with a little bit of preparation and understanding, we can strategically lower our tax bill and keep some of that in our portfolio. You know what I mean? Because once again, at the end of the year, if we have so much capital gains and you still own some positions that you're losing money on, then you can utilize your tax lots. Okay, like right here, I have this little bit right over here. We can select the tax lot, and we can look for whatever is in the negative, and we can just sell that either at the market value, or we can just set a limit order. But that's going to actually bring down, the purpose of that is basically to bring down our capital gain at the end of the year. Okay, if you're going to be selling stuff at a loss, but this tool is going to help us a lot doing that. Okay, all right, let me go back. All right, so lastly, let's briefly cover the long-term capital gains. We're going to be using the same scenario as before. Basically the same concept applies. But the good news is, as I mentioned in my previous video, if you held a security for more than a year, your capital gains tax rate is usually much lower thanks to the income bracket ranges. Okay, or thanks because it's a long term, because you held the position for longer than a year. Okay, it's still going to be it still uses the progressive system, okay, just like I mentioned earlier, how we broke it down. But this time, the rates range from 0% all the way to 20%. That's the highest, okay? We're not going all the way to 37% anymore. So, yes, patience really does pay. Waiting just a bit longer before selling at a profit could mean handing over a lot less to Uncle Sam. You know what I mean? Because come on, let's be real. You want to keep some of that money in your portfolio instead of just giving it up to Uncle Sam. I mean, you still got to pay Uncle Sam, but come on, you got limitations, right? Hello. Anyways, so now, real quick before I wrap this up, let's take a look at the long-term capital gain tax rates. And here it is. If your income is under $48,350, you are sitting pretty at a 0% tax rate. Okay, that's amazing. That's going to make a huge difference. From $48,351 up to $533,400, you will owe 15% on that. And if you're making more than that, hey, congratulations. I'm not going to be hating on you. But if you are making more than that, then you're just looking at 20%. Okay. Already. And there you have it, folks. That's going to wrap up today's video. I hope I was able to keep you engaged or entertained. If you know of someone else that can benefit from it, please don't hesitate to share. If this video was helpful to you in any way, don't forget to hit that like button. And be sure to, if you have any questions or comments, make sure you can leave them down below. I'm gonna be posting on my next video. I'm probably gonna be touching upon. I'm probably gonna be covering dividends and distributions, how they're taxed. I mean, they're not. It's not as complicated as this, but they are taxed differently, unfortunately. But we'll cover some of that on the next video. Okay. All right, people. Thanks so much for tuning in, and a strategic investor out checking out. Take care.